Hello everyone, I'm CA Neeraj.B. Welcome to my YouTube channel @Accounting Buddy NB. In this video, we will begin with closing entries and learn how to record income and expense entries in the journal proper and then transfer them to trading and profit and loss account. Then we will cover rectification, transfer and adjustment entries to know when and where they are passed. You will also learn key adjustment entries like outstanding salary, prepaid expenses and depreciation. Next, we will journalize uncommon transactions like bad debts, asset sales and goods lost by fire. Finally, we will post all entries to the ledger accounts and understand how profits are calculated. Let's dive in and make accounting simple and practical. Let us learn more about closing entries. Closing entries are passed at the end of the year to close the accounts related to revenue and expenses, that is, the nominal accounts, by transferring them to the profit and loss account. Let us further understand the year end closing entries with an illustration. Enter the following in the books of Kohli LLC to close his accounts on 31st December 24. Pass the closing entries and the information is available in terms of the following closing ledger balances. Opening stock of $20,000, purchase of $60,000, wages $16,000, salaries $16,000, sales $88,000, purchase returns $2,000, sales return $3,000, carriage outward $2,500, rent $3,000, insurance $1,000, discount allowed $2,000, discount received $1,000, electricity expenses $2,500, commission received $5,800, interest paid $1,000 and closing stock of $40,000. From the above information, we will identify the nominal accounts and pass the closing entry in the next slide. Basis information given in the previous slide, let us first find out the nominal accounts which will be transferred to trading account of the business to determine the gross profit of the business. In our illustration, these expense nominal accounts are opening stock $20,000, purchases $60,000, wages $16,000 and sales return $3,000. The closing journal entry for expense nominal accounts will appear as displayed on your screens to determine the gross profit of the business. The entry will be passed on the last day of the accounting period, that is 31st December 24. All the expense nominal accounts having a debit balance, therefore they will be credited to close them. Opening stock balance account will be credited by $20,000, purchase account by $60,000, wages account by $16,000 and the sales return account by $3,000. And the second part of the entry will be debited to the trading account for $99,000. Now identify the income nominal accounts for which the closing entry will be passed in the trading account. These income nominal accounts are sales $88,000, purchase return $2,000 and closing stock $40,000. The journal entry for the income nominal accounts will be passed as displayed on your screens to determine the gross profit. The entry will be passed on 31st December 24, that is the last day of the accounting period. All the income nominal accounts with credit balance will be debited to make their final closing balance as nil. Sales accounts will be debited by $88,000, purchase return account by $2,000 and closing stock account by $40,000. The second part of the entry will be passed by crediting trading account for $130,000. Let us understand how the closing entries of the nominal account will be posted in the trading account. Trading account, after posting closing nominal entries, will appear as displayed on your screens. Let us understand how the expense nominal journal entries passed in the previous slide will be posted in the trading account. All the nominal accounts which were credited will be posted to the debit side of the trading account. Similarly, let us understand how the income nominal account journal entries will be posted in the trading account. All the nominal accounts which were debited will be posted to the credit side of the trading account. After posting all the nominal account entries to the trading account, do the totaling of the credit side of the trading account, which in our illustration comes to $130,000. Now deduct all the debit side transactions from the total of the credit side, and we are left with a balance of $31,000 being the gross profit of the business. It is displayed by writing the words to profit and loss account, which means the gross profit of the business is transferred to the profit and loss account. This will make the total of the debit side also equals to $130,000, and the trading account is said to be balanced. Let us now pass a closing journal entry for the nominal accounts at the end of the accounting period in the profit and loss account of the business. The nominal expense accounts which needs to be posted are salary account $16,000, carriage outward account $2,500, rent account $3,000, insurance account $1,000, discount allowed account $2,000, electricity expense account $2,500, interest paid account $1,000. The journal entry for these expense nominal accounts will be passed as appearing on your screens to determine the net profit of the business. The entry will be passed on 31st December 24 by crediting all the nominal expense accounts. Salary account will be credited by $16,000, carriage outward by $2,500, rent by $3,000, insurance account by $1,000, discount allowed account by $2,000, electricity expense account by $2,500, and interest paid account by $1,000. Second aspect of the entry is debited to the profit and loss account for $28,000. The journal entry for income nominal accounts with credit balance of $1,000 for discount received account and $5,800 for commission received account will be passed as displayed on your screens to determine the net profit of the business. Entry is passed on the last day of the accounting period, that is 31st December 24. Both discount received and commission account will be debited with $1,000 and $5,800 respectively. Second aspect of the entry is credited to the profit and loss account for $6,800. Let us learn how the closing entries are posted to the profit and loss account. First of all, the gross profit of $31,000 as determined as per the trading account in the previous slides will be written on the credit side of the profit and loss account by writing the words by trading account. Both the income accounts of discount received and commission account will be posted on the credit side of the profit and loss account for $1,000 and $5,800 respectively. All the expense nominal accounts will be posted to the debit side of the profit and loss account. Now from the total amount of $37,800 of the credit side, when all the debit side transactions are deducted, we are left with $9,800 being the amount of net profit for the accounting period, and it is written as to net profit on the debit side of the profit and loss account. The total of the debit side also becomes $37,800 and thus the account is balanced. The net profit of the business is transferred to the capital account of the business owners by passing the entry displayed. The two accounts which are affected are profit and loss account and capital account. Profit and loss account in this case will be debited and the capital account will be credited by $9,800. Let us understand the terms rectification entries, transfer entries, and adjustment entries. Entries to rectify the errors in the books of original entries or of a ledger are recorded in the journal proper. The journal entries passed to correct the accounting errors is classified as rectification entries. Keeping in view the nature of the accounting error, they can be classified into following four categories: errors of omission, errors of commission, errors of principal, and compensating errors. If an amount is to be transferred from one account to another, such a transfer is also made through journal entry. Such journal entries are called transfer entries. At the end of the year, the amount of expenses or the incomes may have to be adjusted for the amounts paid or received in advance or for amounts yet to be paid. Such adjustments are also made through journal entries and are called adjustment entries. Let us understand the common adjustment entries. First, outstanding expenses. Such entries are passed to record expenses incurred but not paid. Next adjustment entry is prepaid expenses. This includes the entries related to expenses paid in advance for future periods. Another adjustment entry is related to accrued income. Such adjustment entries include entries for income earned but not yet received. Another adjustment entries are related to the income received in advance. This includes the income that has not been earned but is received in advance. Another adjustment type of entry is related to interest on capital. The interest which is decided to be allowed on the proprietor's capital is also passed by an adjustment entry. Depreciation entries passed due to the wear and tear in the value of the fixed assets is also passed through the adjustment entries. Let us further strengthen our understanding of the year-end adjustment entries through an illustration. Pass below adjustment entries in the books of Tolly Trading LLC at the end of the accounting year, that is 31st December 24. First transaction on your screen is salary for the month of December 24 for $20,000 is outstanding. The adjustment journal entry for this transaction will be passed on 31st December 24. The two accounts affected by this transaction are salary account and outstanding salary account. Salary account will be debited and the outstanding salary account will be credited, and the entry will be passed for $20,000 and the proper narration will be written for the adjustment journal entry. Next transaction displayed on your screen is an interest amounting to $2,500 accrued on investment. The adjustment entry will be passed on 31st December 24. The two accounts affected are accrued interest account and interest received account. Accrued interest account will be debited while the interest received account will be credited, and the entry will be passed for $2,500 and the proper narration will also be written for the adjustment entry. Let us take another illustration. Pass below adjustment entries in the books of Tolly Trading LLC at the end of the accounting year 31st December 24. The transaction on your screen is rent for 6 months amounting to $60,000 received in advance. The two accounts affected are rent received account and rent received in advance account. Rent received account will be debited while the rent received in advance account will be credited. The entry will be passed for $60,000 by writing the proper narration. Next transaction on your screen is Trade Association subscription for $6,000 paid for 2 years. The two accounts affected are prepaid subscription account and subscription account. Prepaid subscription account will be debited while the subscription account will be credited. The transaction will be recorded for $6,000 by writing the proper narration for the entry. Pass below adjustment entries in the books of Tolly Trading LLC at the end of the accounting year 31st December 24. The transaction on your screen is business had a closing stock of $50,000. This adjustment closing entry for this event can be passed in two ways. Under option 1, the two accounts affected are closing stock account and trading account. Closing stock account will be debited and the trading account will be credited. The entry will be passed for $50,000 by writing a proper narration. Under option 2, the recording of this event, the two accounts which are affected are closing stock account and purchase account. Closing stock account will be debited while the purchase account will be credited. The entry will be passed for $50,000 by writing the proper narration. Next transaction on your screen is depreciation on furniture $2,000 and on building $5,000 charged for the year. The accounts affected by this transaction are depreciation account, furniture account and building account. Depreciation account will be debited by $7,000 and the furniture account and the building account will be credited by $2,000 and $5,000 respectively. Let us learn few common miscellaneous entries. Apart from the entries we have discussed so far, following business transactions also requires journalizing. Credit purchase of goods other than the goods purchased for resale or material purchased to be used in the production of the goods. Credit purchase entry for such goods is also passed through journal entries. For example, purchase of furniture or machinery on credit will be journalized. Entries related to discount allowed and discount received are also journalized. Another business transaction could be an allowance given to a customer or a charge made to them after the invoice is issued. Another instance of a miscellaneous entry could be when an amount from a customer becomes irrecoverable, say the customer become insolvent, and the business needs to pass a journal entry. Business also sometimes need to pass journal entry in the event of loss of stock or property by fire. Sometimes the owner brings capital in kind. Such an instance is also needs to be recorded via journal entry. Let us take another illustration for the transactions which are not routine in nature. Enter the following transactions in the appropriate books of original entry. Transaction on your screen is on 1st of January 25, Poly LLC was declared insolvent and a sum of $2,000 could not be recovered. This transaction will be recorded on 1st of January 25. The two accounts affected are bad debts account and Poly LLC account. Bad debt account will be debited while the Poly LLC account will be credited. The entry will be passed for $2,000 by writing a proper narration. Next transaction on your screen is on 3rd of January 25, business sold an old machinery to Kuli LLC for $3,000. The transaction will be recorded on 3rd of January 25. The two accounts affected by this transaction are Kuli LLC account and machinery account. Kuli LLC account will be debited and the machinery account will be credited. The transaction will be passed for $3,000 by writing a proper narration. Another transaction on your screen is on 5th of January 25, goods withdrawn from business for personal use for $1,500. This transaction will be recorded on 5th of January 25. The two accounts affected are drawings account and purchase account. Drawings account will be debited and the purchase account will be credited. The entry will be passed for $1,500 by writing the proper narration. Another transaction on your screen is on 6th of January 25, business purchased furniture from Homebox LLC for $5,000. This entry will be recorded on 6th of January 25. The two accounts getting affected are furniture account and Homebox LLC account. Furniture account will be debited and the Homebox LLC account will be credited. The transaction will be recorded for $5,000 by writing a proper narration. Next transaction on your screen is on 7th of January 25, goods worth $2,000 lost by fire. This transaction will be recorded on 7th of January 25. The two accounts affected by this transaction are insurance company account and purchase account. Insurance company account will be debited while the purchase account will be credited. The transaction will be recorded for $2,000 by writing proper narration. Next transaction on your screens is on 9th of January 25, insurance company accepted the claim and settled it for $1,500. This transaction will be recorded on 9th of January 25. The accounts affected by this transaction are bank account, loss of goods by fire account, and insurance company account. Bank account and loss of goods by fire account will be debited with $1,500 and $500 respectively, and the insurance company will be credited with $2,000 by writing the proper narration. Let us study yet another illustration. Tolly LLC took over a running business on 1st of January 25 for a consideration of $100,000. Following assets and liabilities are taken over. Assets which are taken over includes land and building for $40,000, plant and machinery for $45,000, furniture and fixtures for $15,000, stock for $35,000, and sundry debtors for $30,000. While the liabilities which are taken over includes sundry creditors for $35,000 and bank loan for $30,000. The journal entry will look like as displayed on your screens. The entry is passed on 1st of January 25 by debiting all the assets taken over, that is the land and building for $40,000, plant and machinery by $45,000, furniture and fixtures by $15,000, stock by $35,000, and sundry debtors by $30,000. The liabilities taken over, that is the sundry creditors, will be credited by $35,000, bank loan by $30,000. The consideration of $100,000 paid will be credited to the capital account. Proper narration of the entry will be written to explain the nature of the transaction. Let us now learn the difference between the special journal and journal. First basis of difference is nature of transactions recorded. Special journal records transactions of similar nature. For example, the purchase book records only the credit purchases, while the journal does not record transactions of a similar nature. Second basis of difference is format. Special journal is in the format of a statement, while the journal is in the form of a journal. Another basis of difference is that of need. Special journal might not be needed by a business, while the business must have a journal proper. Yet another basis of difference is that of posting. In the special journal, each transaction is not recorded in the ledger separately, while in case of journal ledger, each transaction is recorded in the ledger separately. Another basis of difference is that of rectification. An error in the journal proper is not rectified by a special journal, while an error in special journal is rectified by the journal proper. Question number 16 is a debit note related to purchase return book? And the answer is yes, it is issued when the goods are returned. Question number 17, who maintains the petty cash book? And the answer is the petty cashier. Question number 18, in which account total of purchases return book is recorded? And the answer is purchase return account. Question number 19, what is meant by a sales return book? And the answer is it is a subsidiary book which records return of goods sold. Question number 20, give two examples of entries which appear in a journal proper. And the answer is credit purchase of plant and machinery and credit sale of fixed assets. Question number 34 is which of the following is not recorded in the sales book? And the available options are option A, cash sales, option B, credit sale of goods, option C, sales of merchandise, and option D, credit sales of finished goods. And the correct option is option A, cash sales. Question number 35 is which book is used to record all items not recorded in other subsidiary books? And the available options are option A, sales book, option B purchase book, option C journal proper, and option D cash book. And the correct option is option C journal proper. Question number 36 is the document sent by seller when goods are returned by the buyer is, and the available options are option A invoice, option B debit note, option C receipt, and option D credit note. And the correct answer is option D credit note. Question number 70 is goods returned to suppliers are recorded in the dash, and the correct answer is return outward book. Question number 71 is the book used to record all credit sales return is called dash, and the correct word is sales return book. Question number 72, the cash book serves the purpose of both dash and dash, and the correct words are journal and ledger. Question number 73, transactions that cannot be recorded in any other book are entered in dash. The correct answer is journal proper. Question number 74, recording credit transactions in the cash book is dash. The correct word is not allowed. Question number 75, only dash transactions are recorded in the purchases book. The correct answer is credit transactions. 76 question number is the total of sales book is posted to dash account, and the correct answer is sales account. Question number 77, trade discount is dash recorded in the books. The correct answer is not recorded in the books. In my upcoming lesson on 9th August 25, you will learn how to classify business transactions into subsidiary books. You will also learn how to record entries in the double column cash book, purchase and sales book, including returns. We will also work with the journal proper and summarize all entries across 6 major subsidiary books. Then we will post these entries into the relevant ledger accounts like capital, asset, and supplier accounts. Finally, we will prepare a trial balance, understand its purpose, and how it ensures accuracy before financial statements are prepared. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share, and like my YouTube channel @AccountingBuddyNB. Thank you and goodbye for now.